So let's talk about one of the biggest questions in investing. How do you actually figure out what a company is really worth? Today, we're going to dive deep into a professional financial report that does just that for a huge company, Asian Paints. We'll see exactly how the pros do it.
You see, the stock market gives you a price for a company every single day. But that price, it's pushed and pulled by millions of people, by the daily news, even just by the general mood of the market. That's the market value. But what analysts try to find is the intrinsic value, the true fundamental worth of the business itself. And you know what? Sometimes those two numbers are worlds apart.
To make this all concrete, we're looking at Asian Paints. I mean, they're a household name, a giant in their field. This isn't some obscure startup. We're talking about a blue-chip company here. So what happens when a team of sharp analysts puts its value under a microscope?
Okay, this is where it gets really interesting. Let's jump right to the report's big conclusion, which, well, it presents a tale of two very, very different numbers.
First up, you've got the market price. At the time this report was written, if you wanted to buy one share of Asian Paints, it would have set you back 2,874 rupees. That's the price set by the daily dance of buyers and sellers. It's the number you see lighting up your screen. Simple enough, right?
But then you have the number the report came up with. After all their models were run and all the financials were analyzed, the analysts concluded that the real intrinsic value of one share was just 797 rupees. Wow, that is a massive, massive difference.
I mean, just look at that gap. The market is pricing the company at more than 3.5 times what these analysts think it's fundamentally worth. So the big question is, how on earth did they get to that 797 rupee figure? Well, the report used two classic methods.
All right, method number one. I like to call this one the crystal ball. It's all about trying to peer into the future to figure out what a company is worth today. Now, the fancy official name for this is discounted cash flow, or DCF. The logic is actually pretty simple. A company is worth the sum of all the cash it will ever make. The hard part, of course, is guessing all that future cash and then figuring out what that money in the future is worth to you right now.
So here's how it works in 3 basic steps. First, the analysts forecast the company's profits way out into the future. Second, they apply something called a discount rate. That's a percentage that basically penalizes the future cash for risk and for the simple fact that a rupee today is worth more than a rupee tomorrow. And finally, they add it all up to get one single value for the company today.
And what was the result? After running that whole DCF analysis, the report calculates a value of 797 rupees per share. So that's our first number, straight from the crystal ball. But hey, you never want to rely on just one method, right? So the report uses a second approach. You can think of this one as the popularity contest. Instead of looking into the future, this method looks sideways at the company's direct competitors.
This is called comparable analysis. And it's based on a pretty common-sense idea. Similar companies should probably be valued in a similar way. Analysts use metrics to compare them, and one of the most common is the price-to-earnings ratio, or PE. It basically tells you how much investors are willing to pay for every single rupee of a company's profit. And here, you can see that investors are paying over 70 times Asian Paints earnings for one share. That's a higher multiple than its close competitor, Burger Paints, and it absolutely dwarfs Kansai Nerolac. This suggests that the market sees Asian Paints as the premium, best-in-class company and is willing to pay up for things the models might not capture, like its amazing brand loyalty and dominant market position.
So, what happens if you value Asian Paints based on its peers? Well, using that PE metric, the report comes up with an implied value of about 1,758 rupees per share. Now notice, this is much higher than the crystal ball method, but it's still significantly lower than the actual market price. So we have two different methods, and both are pointing in the same general direction. Let's pull it all together and look at the final verdict.
When you put all the numbers side by side like this, the story becomes crystal clear. You've got the market price way up at the top, and then you have the two analytical values sitting far, far below it. Whether you use the crystal ball or the popularity contest, the math in this report tells a consistent story.
And that story leads right to the report's final conclusion, written right here. The analysts determined that based on their models, the stock is significantly overvalued. Plain and simple, the price the market is paying is way higher than what these standard financial methods say it's worth. But here is the most important thing to take away from all this. A financial valuation is an estimate, an educated guess. It is not a fact set in stone. The market might be overpaying, or the analyst's models might be missing something really important about Asian Paint's future. So this leaves us with the real question. If you had to decide which price is right,
What other clues about the company, its brand, or its industry would you look for? Because that's what turns a number on a page into a true investment decision.